You can see the topic of my talk here, metals in a Fed-obsessed world. I mean, we've been living in a Fed-obsessed world for quite some time. When I gave a talk a couple weeks ago or a month ago, I titled it, What Forest? All I See Are Trees, because there's just been this obsession with data points, right? And like any data point that comes out and there's some quite substantial reaction to it, and the reaction doesn't always make a lot of fundamental sense, especially on the metals, for the metals side of things. I wanted to step back from individual data points, talking about, inflation points or jobless claims, things like that, and just sort of look at where I think we're going in this Fed obsessed world. Where we're sitting right now is that things are pretty darn good, but they're also pretty bad for metals, right? So we have gold near all-time highs, but we do not have a gold equity market. Like, it just, maybe that's a slight overstatement from someone who wishes we had one, but really, gold equities can't really catch a bid despite the fact that gold is doing, is at a great price. Copper, the equity side isn't as soft, but the copper market is very strong. The fundamentals are very strong, but the stocks remain pretty cheap. I mean, I just have two stocks there, Hudbay and Adventus, so one producer, one developer, and they're both just sort of boring stock charts. Yet, if you look at the last year of that 5-year copper price chart, they shouldn't be boring, right? And these are just examples of the fact that it's all good in terms of metal prices, but it's not good in terms of the market. And why is it good for, well, okay, so while we stay in this sort of big picture look at things, it is all good for gold in that we are in a negative real rate environment, and negative real rates are the thing that matter. They are the most important bull force for gold. If you look back to 2016, the gold bull market started. This is a chart of essentially real rates. Use the 10-year treasury, inflation index. So it's sort of to account for inflation. So this is a good proxy for real rates. The gold bull market started in 2016 when, guess what? Real rates started falling. Rebounding real rates sort of hindered the gold market for a few years there. And then in 2019, they had to start cutting rates again. I will get back to that thought at the end of my talk, so remember it. And the gold bull market phase 2 really got going again. And then COVID hit, and bam, real rates were plunged into very negative territory. And they're set to remain there for a long time. That's another conclusion that I'm coming to here. And real rates and gold have incredibly good correlation. That's what the chart on the bottom shows. It's gold inverted with real rates, and they stick together like nobody's business. So that's why the gold price works. The other metals, I'm painting with broad strokes here, but you look at copper, silver, nickel, uranium, platinum group metals, metallurgical coal, they're all doing pretty well. Well, silver isn't doing super well yet, but the point is that supplies will not meet demand in the coming years for all of those commodities. And so that is what's propelling prices upward. So this is just me saying it's all good, right? Look, palladium, metallurgical coal is going nuts. Uranium is really going nuts. I will actually spend my entire talk tomorrow on uranium, so I will not dive into that situation right now. But if you're interested, then tune in for the first session tomorrow, and I'll dive through what's going on there. So if everything's so good, then why is it so bad? Where are the investors? Well, they're investing in other things because the markets keep rising, right? How is that going to change? When is that? What's going to change that? Well, I think it's all about tightening. Getting right back to my first slide, we live in this ridiculous Fed-obsessed world. That is the situation, whether you like it or not. And so it's all about tightening. When I was, during this summer when I gave talks, I was like I said, I was focusing on individual data points and how the market was reacting to individual data points. And the reactions didn't necessarily make sense because the only game out there was trying to get ahead of the Fed, which is really hard to do. So let's assume that the Fed is trying to tighten. I'm not just making that assumption out of thin air. The Fed Chair Powell has certainly made clear that he wants to go in that direction. And so let's assume that is going to happen. We can talk about time frame in a moment. Gold likes tightening, at least initially. Remember that chart that I showed about how the gold bull market correlated with real rates? Well, the gold bull market started when real rates, or when with the initiation of a rate hike cycle. I know that seems backwards, but it's the backwards thing there is that the market seems to like this official validation that inflation is happening. That's when the Fed raises rates. That's the official, okay, we have inflation. You know, it matters not that there have been many signs of inflation already. The point is that the Fed endorses it. And so gold, being the first and best hedge against inflation, gets that sudden influx of interest. So gold performs with tightening, especially at the beginning of a tightening cycle. But these days, nothing is so simple. I know this is a very long quote here, but the essence of this quote is that anytime our current setup, the way that the market and the Fed dance, is that anytime there's a crisis or a scare or a recession, or even just a steep stock market decline, the Fed steps into supportive stance. That's what the Fed now does. And we've seen it for 15 years. And I don't think it's going to change anytime soon. And they step in with the speed and magnitude of their monetization ramping up until equity and consumer prices resume their long-term upwards trends. This is what's been going on for decades and explains why the US stock market's valuation keeps making higher highs and higher lows. Because that's what the Fed does now, is it just supports these things. And it talks about inflation, but certainly the stock market is the other thing that it is blatantly supporting. So when Powell does talk or start tightening, and I think that will happen this fall, whether it's this month, more likely in November, gold should gain as the inflation hedge, the first and foremost inflation hedge. That's the quick reaction that always happens. Base metals should gain too, because inflation is growth and base metals are needed for growth, and that's all good. But the market's going to throw a fit. There's no question that the market is going to throw a fit. We saw this playbook already. Remember when the Fed started tightening? And there was this thing called taper tantrum a couple years ago, right? The Fed was raising rates. They stepped them up a few times through 2018. And then they wanted to also reduce bond buying. And then the market tanked. I mean, tanked in a very relative sense. It declined, 15% or something. And the Fed stepped in, backtracked completely, and reversed course. So let's look at what a tantrum would mean today, because that's very much what I expect will happen when the Fed starts to tighten in whichever form that takes. I imagine they will start by tapering bond purchases sometime later this year. I imagine the market will sort of, eat that for a little bit, and then they'll throw a fit. Well, what will that fit mean for gold? I actually think it would be the best possible outcome. If the market throws a fit and the Fed has to back off from tightening, I think that backing off would just underline, once again, but very clearly this time, that negative real rates are here to stay. There's no alternative. That's the only path forward at this point. As for what gold equities would do, I acknowledge that we are in a negative real rate environment already, and yet we don't have a gold equity market. So I get that there's a disconnect. What I think will matter is how strong the gold price is before when this all happens, when this tantrum happens. If the price has gained enough to make a splash, maybe that means getting above sort of 1900 as an important psychological level. I'm not sure what level will be needed, but you combine complete affirmation that we are in a negative real rate environment forever, a long time at least, with gold therefore gaining and gold equities being undervalued relative to the rest of the market. And I really do think that gold equities stand a chance of doing well as the gold market performs in a taper tantrum. I know I'm sort of combining a lot of things here, but this is the way that I have to approach it. I've just charted the gold price here as a reminder, as a graphical representation of the things that I've just been talking about. Back at the beginning of 2016, the initial rate hikes of the cycle kicked off the gold bull market. Then gold was sideways as the market was increasingly like, oh, we don't like this tightening, please. But the market back in 2017, 2018, so long ago, wasn't so forthright in their hatred of rate hikes. They were a little bit more like, oh, I guess we should let the Fed do what the Fed does. These days, they are more blatant in their responses, I think. So gold was sideways as the markets were like, oh, I guess we have to go through this tightening. And then when the Fed decided to throw tapering into the tightening mix, the market threw a fit and gold started to gain. And then as the Fed dropped rates 3 times through 2019, look what happened to the price of gold. Then we get into the COVID world, which was its own thing. And I'm not trying to connect that with sort of this fundamental look. But I think we could be set up for a repeat of this pattern, but with the sideways section shortened. Because like I say, I really think the market won't stand for tightening for very long. They have seen that by getting mad at tightening, by letting stock prices slide, the Fed steps in and reverses course. So why would they put up with it for very long? I think the market will have its fit in fairly short order. And this gain with hikes or tightening, whatever the first tightening looks like, sideways for a little bit as the market is like, ew, tightening, what's going on? And then the market will throw a fit, the Fed will have to back off, and then I think gold will go up the way that it did in 2019. And I've sort of, in a very highly artistic manner, charted that on the right side of the graph here. Okay, what will a tantrum mean for base metals? Well, it's a little bit harder to know. In that 2018-2019 taper tantrum and subsequent rate cut scenario, copper struggled a little, actually. So if we're looking at the PhD of base metals, it didn't do so well in that period. But I think we also have to acknowledge that the market relates to rate hikes differently now than it did back then. Before, it felt like it had to tolerate them. And there was still some connection between rate hikes and growth, which there should be a connection. Rates should go up because there's inflation. Inflation should happen because there's growth. Those things are not necessarily connected the way that they should be anymore. So that's why I put that question there. Does anybody actually really connect growth with rate hikes anymore? I don't think that that's so much of a connection. Instead, I think supply-demand fundamentals matter more. And in the electrification paradigm shift that we are in, guess what? Most of those metals, like I said at the beginning, are in a deficit. So I don't know exactly. I think that base metals would probably do fine in this taper tantrum scenario that I'm painting, but it's a little bit harder to know precisely. Okay, so what does this all mean that we should do right now? First of all, I think you should pay some attention to Powell, as if people aren't. But okay, so his next press conference, Fed meeting, and then press conference is just next week, actually. If he does not talk about tightening, give some sort of timeline or structure for how he will reduce bond buying, let alone, I don't think he'll talk about raising rates. I think he might talk about reducing bond purchases. But if he doesn't talk about it next week, then I think gold will stay boring until he does talk about it. And the next opportunity for him to do so would be November, which is his next press conference. So that's one thing to watch next week. I don't think it will hurt gold in particular. Gold has been pretty range bound. I think it will stay in this range. It'll just remain boring if tightening is again kicked down the road a little bit. If that's the case, then focus on some other things that are doing just fine in this environment. I think copper is doing fine. Uranium, I'll talk about tomorrow. There are other things to sort of focus on until gold gets its moment. The reason that there are other things to focus on is because the electrification trade is very real. I advocate approaching that trade with more of a medium-term horizon. As I was writing this, I was like, build a position and they will come, right? It's hard to trade a paradigm shift on the short term. There's certainly opportunities based on discovery or based on the specifics of one particular stock. But more generally, I would say build a position in the metals that you believe are key to the electrification paradigm shift, and it will happen because there's just no alternative here. There's also this thing called exploration results. Now, I say that in that way because labs are very, very, very slow again, which is not ideal, but results are starting to come in from the summer field season across the Northern Hemisphere. And there's always lots of fun ways to play exploration results, right? If you really have confidence in particular targets, if you think that the market is going to get excited about a particular set of results, you can buy and even sell before those results come in. Like, there are ways to play the exploration season that can be a lot of fun, risky, but fun. I mean, I was just down in Beaver Creek, which is a conference where people like myself, the investor side, sits down across the table from issuers. And, then you spend a lot of time having coffee and bumping into people in the hall and chatting about new deals. What else are you putting together? What do you believe in? What do you think is going to happen next? How are you positioning? And, the market believers, there's a lot of them out there in our sector for the reasons that I've just described. They're very much still creating new deals. So there's interesting opportunity on the new deal front. And then the end of the day, gold miners are ridiculously cheap. So when the moment comes, and at this point, I don't know when that's going to be. I feel like we've pushed it off somewhat. I think the first quarter of next year is a more likely opportunity for reliable gold gains, unless Powell talks about tightening next week. This I actually haven't updated in the last month, so the numbers are probably not exactly right, but miners really stand out across equities, like for balance sheets, for free cash flows, for dividend yields. Like, it's ridiculous, actually. It's annoying because why don't we have a gold equity market? But anyways, we don't, but they're very cheap. And so that means that when interest does rotate back towards the gold space, I really think that it could flood, because people will say, whoa, these gold miners are printing cash and they're in net cash positions. That is very unusual in the stock market these days. So they offer fundamental investment sense. Like, it doesn't matter whether you like gold or not, they just make a lot of financial sense. And then they offer upside for those who do believe in the metals market. That's what I have to say. Hopefully that made some sense. I was trying to pull together a lot of ideas. I, of course, write 2 newsletters, the Maven letter, which is my weekly letter on what I'm buying, selling, and thinking in the market. The premium is about financing opportunities for accredited, engaged retail investors who would like to know when I'm putting money in a financing and maybe want to participate alongside. And then the Peter, who has joined me in Resource Maven, publishes 2 newsletters as well, one that's focused on silver and one that is focused on low risk opportunities.